Hello and welcome to the Explainer.
So today we're going to dissect the creation of LuxExperience, which is this new powerhouse in online luxury fashion. And it was born from a landmark deal in a really turbulent market. For any of you value investors watching, this is a fascinating story. It's complex, it's full of transformation, risk, and just maybe massive opportunity. To really understand the opportunity here with LuxExperience, you first have to look at the spectacular collapse of its rival Farfetch. Their whole empire-building strategy just blew up. Equity got wiped out, and it left major brands like Kering totally in the lurch. This implosion created this huge vacuum in the European market, and that really set the stage for a new leader to step in and consolidate power. And that brings us right to the deal itself. This, right here, is the absolute core of the investment case. So what is LuxExperience? Well, effective May 1st, 2025, the super efficient and profitable Mytheresa acquired the much larger but struggling YOOX Net-a-Porter group, or YNAP, from the luxury giant Richemont. This new combined company was renamed LuxExperience, and it now trades under the ticker LUXE. And just like that, it basically tripled the size of Mytheresa's business overnight. And if you want to know just how good the terms were for Mytheresa, just listen to how this one investor at the Sum Zero conference put it. It's pretty blunt. See, after Richemont's deal with Farfetch fell through, they were in a really tough spot with these underperforming YNAP assets. So they essentially paid the smaller, better-run Mytheresa to just take the whole problem off their hands. Okay, so this brings up a really key question for any investor. When did the money from Richemont actually arrive? Immediately, right away. The regulatory filings are crystal clear on this. On April 23, 2025, the moment the deal closed, the YNAP assets were transferred with a net cash position of 555 million euros and no financial debt. This wasn't some promise of future cash. It was a massive capital injection straight onto the new company's balance sheet from day one. All right, let's really dive into this because this is the heart of the whole investment thesis. Mytheresa, a company worth about 1 billion euros, goes and acquires assets 3 times its size. In return, Richemont doesn't get cash, they get a 33% stake in the new company. But here is the kicker. Richemont also handed over the YNAP businesses plus over €500 million in cash and a 100 million euro credit line. They basically paid a premium to have a proven management team come in and fix their problem while still keeping a piece of the potential upside. So the deal is done. The question now becomes, how is Mytheresa's proven management team actually going to integrate these massive and in some cases really underperforming assets? Well, management has laid out a really clear 5-pillar plan. It starts with making sure each brand, Net-a-Porter, Mytheresa, all of them, keeps its own unique identity while they slash complexity in the back office. They'll optimize logistics, but the real key here, the linchpin, is the tech migration, moving Net-a-Porter onto Mytheresa's way better platform. That one move is expected to unlock massive cost savings. It's the cornerstone of the whole plan. To manage all this, the company's now organized into 3 distinct segments. You've got 2 luxury pillars, Mytheresa and the Net-a-Porter Group, and then a completely separate off-price division. What's so critical here is that there's very little customer overlap between them, which lets management run really targeted, specific strategies for each business line. And this separation, this might just be the most clever part of the whole strategy. By basically building a wall around that off-price business, management has given themselves some really valuable options. If the turnaround of YOOX doesn't hit its targets, hey, they can just sell it or shut it down without hurting the core high-margin luxury engine. It's a brilliant move that seriously de-risks the entire investment case. But look, this transformation isn't a walk in the park. It comes with some pretty significant hurdles and risks that any investor absolutely has to consider. While those luxury segments are definitely the crown jewels, you just can't ignore the off-price business. I mean, look at the chart. It represents nearly 1/3 of the group's total volume, but right now, it's losing money. This is, without a doubt, the biggest turnaround challenge and the #1 source of execution risk in this whole plan. The market always wants quick wins, but this is not one of them. Management has been very clear that this is a 24 to 36-month process. The major benefits, especially from that big tech migration, won't be fully felt until fiscal year 2028. So this whole thing is going to require some patience. And it comes with a pretty hefty price tag of 200 to 250 million euros in restructuring costs. Okay, let's just break down the risks. First, integration risk. I mean, trying to merge these massive companies is incredibly complex. Second, synergy risk. Will they actually hit that huge 70% tech cost reduction target? Third, the turnaround risk we just talked about with the off-price business. And finally, you've got the big external stuff, the macroeconomic pressures. A global recession or a continued slowdown in China, a huge market for luxury, could hit demand really hard. All right, so with all that in mind, the opportunity, the plan, the risks, let's get to the bottom line. How does this all shake out in the financial outlook?
And this brings us right back to that beautiful balance sheet. This is so important. Despite that 200 to 250 million euro restructuring cost, the entire plan is fully funded internally. Thanks to Richemont's cash injection and their credit lines, they have a liquidity buffer of over 300 million euros. To put it simply, they will not need to go out and raise more capital to get this done.
So what's the end game here? What's the big prize? Well, management is targeting over 4 billion euros in sales and getting back to a really healthy 7 to 9% adjusted EBITDA margin. At that level, we're talking about the company generating over 300 million euros in adjusted EBITDA. That's a massive number compared to its current market value. Now, that path to a 7 to 9% margin, it's not going to be a straight line up. The company will be about break-even on an adjusted EBITDA basis in its first year, but as those synergies start to kick in, profitability is expected to climb pretty steadily, hitting the low to mid-single digits in the next couple of years before it finally reaches that long-term target. And that leaves us with the final and, I think, pretty provocative thought for any potential investor. The deal is done. The cash is on the balance sheet, and a proven management team has a fully funded plan. But because all the big financial benefits are still 2 to 3 years away, the market seems to be overlooking the potential here. So the question is this one of those rare opportunities to invest in a market leader's transformation before the turnaround becomes obvious to everyone else?